Hello everyone, I'm Ranjitha B.R. Today I have come out with a new video on the introduction to financial accounting, wherein I'm going to discuss about the concepts and convention of financial accounting. Accounting concepts are the fundamental ideas or basic assumptions underlying the theory and practice of accounting. There are some important accounting concepts which are business entity concept, which is also called as separate legal entity, money measurement concept, going concern concept, accounting period concept, cost concept, dual aspect concept, realization concept or revenue recognition, matching concept. The term concept refers to the assumption and ideas which are fundamental to accounting practice. So accounting concepts are the fundamental ideas or a basic assumption underlying the theory and practice of accounting and are broad working rules for all accounting activities. First I take up business entity concept. In accounting, we distinguish between the business and its proprietors. Business is assumed to have distinct entity and we have to record business transaction from business point of view and never from the viewpoint of proprietor. Every business undertaking, whether it is a joint stock company or a partnership firm or a sole trading concern, is regarded as a distinct unit. While making decisions regarding the asset, liability, capital, revenue and expense, business viewpoint is taken into consideration. Capital contributed by the owner is a liability for the business because business is different from owner. Any money withdrawn by the proprietor is considered as a drawings and reduction in a capital contribution. Profit is liability and loss is an asset. All entries are kept from the point of view of business and not from owner. So an enterprise is economic unit separate from owner. Next concept is money measurement concept. Money measurement concept means that in accounting a record is made only of those transactions which can be measured in terms of money. Non-monetary events like an appointment of a manager, a retirement of an accountant, quality of the products, which are also material events and qualitative, but they cannot be measured and expressed in terms of money. So they are not recorded. Only those transactions which have a monetary value are recorded in the books of accounts. Recording transaction in monetary terms makes the information more meaningful.
You need to unlock your device to do this.
Next concept is realization concept. This concept states that revenue is earned from the sale of goods or from provision of services to customers, and revenue is said to be recognized or considered to be realized only when goods or services are transferred to a customer and the customer becomes legally liable to pay for them. So when an order is received from a customer, it does not mean that revenue is realized or earned, even if an advance payment is received from a customer. So no future income is considered. Goods sold on approval will be included in sales but on cost only. This concept tells us when revenue is treated as realized or earned. It is treated as realized on the date when property in goods passes to buyer and he becomes legally liable to pay. Next concept is going concern concept. Business is a going concern and transactions are recorded accordingly. This concept means an enterprise is regarded as a going concern, that is concern that continue to operate for an indefinitely for a long period of time. There is neither the intention nor the necessity to wind up the concern in the future. Therefore, on the basis of this concept, the financial statements are prepared and the fixed assets are valued at their cost price and are charged necessary depreciation on them. The market value or the realizable value of the asset are not at all considered in the case of going concern concept because the assets are meant for continuous use in the business and not for selling them in a profit. On the basis of this concept, the outstanding expenses, outstanding incomes, the prepaid expenses, income received in advance, the capital expenditure and revenue expenditure are duly adjusted in the accounts of the current year so as to ascertain the result of the business. Next concept is dual concept. Every transaction has a double effect. Accounting equation assets equals capital plus liability. Under this concept, every business transaction has a twofold effect, that is receiving of benefit of some value and giving of some other benefit of equal value. For instance, when a business purchases goods for cash, it receives goods of some value and gives cash of equal value. Similarly, when it sells goods for cash, it receives cash of some value and gives goods of equal value. Thus, every business transaction involves dual or a double aspect of equal value. The twofold effect can recorded under this dual aspect concept. Then accrual concept. The accrual concept states that the future consequences of a transaction arises when a transaction is entered into books of accounts. So all transactions must be brought into record, whether they are settled in cash or not. It suggests that all the items of the revenue will be treated as such for which there is a legal right to receive them, even though cash might not have been received for the same. Similarly, the items of expenses are treated as such for which there is a legal obligation to pay them, even though cash might not have been paid for the same. This concept has given rise to the introduction of accrual system of accounting as against cash system of accounting. Next concept is matching concept. The matching concept is an accounting practice whereby firms recognize revenues and their related expenses in the same accounting period. Firms report revenues, that is, along with the expenses that brought them. The purpose of the matching concept is to avoid misstating earnings for a period. This concept, the whole business structure is based upon the desire to earn profit. Profit is the result of two factors, namely revenue and expenses. So for the measurement of the profit or loss, these two factors are matched or compared and result balance is taken as a net profit or the net loss. If the revenues exceeds the expenses, the result balance is taken as the net profit. Instead, if the expenses exceeds revenue, the result balance is taken as the net loss. Next one, accounting period concept. The accounting period concept comes from the going concern concept. Under going concern concept, the financial result of a business can be ascertained only on the liquidation of the business. But the ascertainment of the profit or loss and the financial position of business on liquidation will not be helpful in knowing the periodical progress or performance of the business. Generally, the profit or loss and financial position of the business are required by different users at regular intervals for various purposes. The financial statements are therefore prepared at regular intervals, normally after a period of 1 year, so that timely information is made available to the user. The accounting period concept means that the measuring the financial result of a business periodically, the working life of a business is split into convenient short period of time called accounting period. The length of accounting period depends on the nature of the business and needs of the proprietor of the business. At present, accounting period are regarded as the period of 12 months. According to the Companies Act and Banking Regulation Act, accounting period should consist of 12 months. The accounting year may be English calendar year or financial year as per the government. So we move on to the accounting conventions. Accounting conventions are the practices which are followed by the accountants as a guide in the preparation of financial statements of a business. These conventions are the customs, traditions or practices which are followed by the accountants as a guide in the preparation of financial statement of a business concern. Following are the important accounting conventions. Number 1, Convention of Materiality. Next, Convention of Conservatism. Next, Convention of Consistency. And next one, Convention of Full Disclosure. So let me discuss the Convention of Materiality. In accounting, a detailed record is made only to those business transactions which are material or significant to the users of accounting information, and insignificant transactions are ignored or not recorded. The rationale behind the Convention of Materiality is that if insignificant transaction is recorded in the books of accounts, accounting records will be burdened with unnecessary details. So only those transactions which are significant to the users are only recorded. Next one, Convention of Conservatism. The Convention of Conservatism means that the convention of caution or the policy of playing safe. That is, in the accounting records and the financial statements of a business, all the prospective losses should be taken note of and provided for, but prospective profits should be ignored. Conservatism in financial statements demands that we should avoid uncertainties and make sufficient provision for unforeseen losses. For example, if we value stock at cost price or market price, whichever is lower, we go on depreciating land and building, though there may be appreciation in its value. Next, Convention of Consistency. The Convention of Consistency means that the accounting practices and methods should remain unchanged from one accounting year to another. For example, if the business has been charging a depreciation on its fixed asset according to straight line method, it should go on charging depreciation with the same method every year. Similarly, if the stock and investments are valued at cost or market price, whichever is lower, the same practice should be continued in all the future years. And the next convention is accounting for full disclosure. The convention, a full disclosure, means that all material and the relevant facts concerning financial performance of an enterprise must be fully and completely disclosed in the financial statement and their accompanying footnotes. For example, in the case of sundry debtors, not only the total amount of sundry debtors should be disclosed, but also the amount of good and secured debtors, the amount of good but unsecured debtors, and the amount of doubtful debts, etc., should be disclosed. In the case of fixed assets, their cost prices, the depreciation, written off, etc., should be disclosed. So, by this, I end this video. Thank you. Thank you, one and all.